Hi there, welcome to Funding by Alex. My name is Alex. Today I would like to talk about valuation for startups. So, when is this relevant and why? This is first of all to determine the value of a business. So, in essence, if you want to sell a business or buy a business, the valuation is very important. That actually tells you what it's worth. Then, to determine the value of an investment. So, someone who buys a share in the company needs to know what the company is worth. That's why you apply a valuation. And last but not least, when raising funds and issuing new shares. So, in essence, when you sell a part of your company, you issue new shares. You want to have new investors into your company. That's when you apply a valuation method. So there are multiple valuation methods. First of all, market capitalization. It's basically the price per share times the number of shares outstanding. So this is very easy to calculate, but it only applies for public companies because how can you know what a private company shares are like? So in the end, market capitalization is more applicable for publicly traded companies. The second is a revenue multiplier. So basically, the revenue you're making and then a multiple of that. This can differ per industry. This is usually benchmarked to other companies in the same industry. Then the third is earnings multiplier. So that's EBITDA, earnings before interest, depreciation, taxes, depreciations, and amortization. In essence, this is a similar multiplier you are applying. So in essence, it's revenue multiplier and earnings multiplier. Earnings multiplier is basically based on the profit, not the revenue. Then there is a discounted cash flow method, DCF method for short. This calculates the future cash flows at a discount rate, so discount foot. This is in essence like, okay, a euro this year is worth more than a euro in, let's say, 10 years' time. So there is a discount that you need to apply for revenues in 10 years. Then book value, this is basically assets minus liabilities. And last but not least, liquidation value, which is if you were to liquidate all the assets, what would it all be worth? So these are the six valuation methods. Usually, when investors are looking at companies, they are doing like multiple valuation methods. So there are three, four, maybe they are applying. You are looking at a median, so an average where sanity check. You are doing a sanity check on multiple valuation methods, and then you come up with a reasonable number. Let me put it this way: in the end, there is no right or wrong. Valuation methods in the end are very subjective. So you're looking at companies that are thinking they are worth more than investors think they are worth, and it's always, when you sell your house, you think it's worth $1 million. Someone else maybe thinks it's worth $100,000. That's agree to disagree and come to a um, yeah agreement on that. But Alex, I hear you say I am pre-revenue, meaning I haven't made a cent. I only have a plan. I need pre-seed funding. I need seed funding. Then, in that case, valuation is very hard to determine. Usually, what you're getting is a standard deal from a venture capital fund, like an early stage venture capital fund or an angel investor who will basically just give you the money based on, maybe not even look at the valuation. Then focus on getting traction first. So if you actually want to play with a valuation, you need to get started. Like it's a soft start, a soft launch. Get something going. Yeah, not just I have a plan and I'm waiting for that plan for the perfect moment to start, and I need to have the money before I start. Last but not least, don't price yourself out of the market. Meaning, don't raise money based on some very crazily high valuation. I've touched on this before, but the point is like if you now raise money based on a very high valuation, the next time you need money, meaning if you never need money anymore after the first round, of course, by all means, but assuming that you need more growth capital in the future, don't price yourself out of the market because the next round of equity will be very expensive for investors to get into, meaning it will become more hard to or harder to actually raise money for you. So then you've maybe heard about this pre-money, post-money. Pre-money is the worth of the company, the value of the company before the investment, and then post-money basically is the valuation of the company plus the investment. So that's the post-money valuation, basically. What will it be worth? So raise with the next rounds in mind. I think I've spent some time already going over this in the previous slide, but in essence, you need more money to grow. You have a roadmap where you can't get all of your funding in one go. You need to hit certain milestones to unlock more funding. Now, avoid a down round by not being greedy. That means if you value your company currently at $1 million, say, um, then the next round, when you raise, the valuation should not be lower. Yeah, you always have to go up. Your investors who have invested based on a valuation of $1 million will actually be very, very upset if it's gone. The valuation in the next round is less than $1 million. So, meaning the next consecutive investors, they're paying less for the same equity that they have paid for. Then I really would like to stress this very much. Don't fake it, build real traction and revenue. Now, what happens quite a lot is when founders are starting out, they are basically mesmerized by, oh, there's someone actually who wants to give me a lot of funding, basically. And uh, they are trying all sorts of tricks to pump up their revenue to make it seem like they're profitable or make it seem like their revenue is higher than it is. There is no real traction. Maybe they are faking it with regards to users that they have for their product. um, all artificial methods to pump up your valuation. Now, the problem with that is that in the short term, that might seem very appealing. Yeah, fake it till you make it, and then fake it some more. That is, yeah, quite a usual expression. It's just that you will eventually be caught. It will catch up with you, basically. So in the end, you will end up, or someone will give you $10 million to build a company, but then you have no way to know what works. So you might be scaling at negative margins. You might be scaling something that is not working, basically. Meaning you waste a lot of money. You waste the money of the investor. You waste your time and, yeah, also your reputation in the end. There are very good examples to heed, yeah, in the market, basically. Indonesia, but also like, the WeWork disaster. You have a lot of companies that actually had, yeah, quite a lot of, based on a good story and, maybe personal relationships, you can get along a lot of funding. It's just that in the end, yeah, there was nothing there. When you actually open up the hood, there's no engine. That is the thing. So I would like to stress: start small, stay small, keep the cost low. Even if you get funding, don't spend it all. Try and see what works, and then scale. I hope these pointers have been helpful for you. I'm also running a consultancy company, Golden Dragon Capital. If you would like to connect with me, I'm reachable at alex@goldendragoncapital.co. I'm available for fundraising projects. I'm helping investors, early stage startups, but also more established companies with M&A, with fundraising, pre-seed, seed, growth capital, basically. Would you like to engage me? You can. I am reachable at the alex@goldendragoncapital.co. Thank you very much for your attention, and please don't forget to like and subscribe if this was helpful for you. Thank you.